Hello world, welcome to Farm the Market. A few days ago I posted a video talking about the myths that surround the option selling strategies on YouTube. I mainly focused on the selling of cash secured puts and the wheel strategy. And well, in case you haven't watched that video, I recommend that you watch it first, because the idea of this video is to take a deeper look into what a strategy of this kind might actually look like in reality, or well, what it actually looks like in reality. Whenever you stumble upon a video like the one you see here on YouTube, well, you might go with the idea that it's very easy and in a consistent way you can just make a weekly or monthly income just by selling options, but the reality is very different. So I invite you to take off, sorry, the rose-colored glasses, and let's look into actual results of my put selling strategy for the past 2 years and a half. Well, first of all, a disclaimer. This is just my strategy. I'm going to share with you the actual numbers of my strategy, but of course, it's not the only way to do it, and I am not recommending you to do it like this. As with every one of my videos, this is first of all and usually an exercise for me, because it helps me out to explain what I'm doing, to find to find and analyze what I might be doing wrong or what I can improve, and at the same time, if you can get some value from it, well, that's great too. But remember, this is not a recommendation to do to just copy paste what I'm doing, because that's not the point. So I hope you find this interesting. So what's the strategy? Well, I'm going to share with you the numbers of my put selling strategy. Basically, it's a short-term trading strategy where I sell puts to collect premium. Nothing fancy. One main distinction I want to make is that I do not want to own the stocks at any point. So this is not comparable with the wheel strategy. And as I mentioned in the last video, all I care about is selling stocks that I think have a decent setup and have a nice premium. So crappy stocks are welcome, as long as I think I can get good value from selling the option at that particular point in time. I'll do it, and I will share with you a list of some of the stocks that I traded, so you can get an idea of the quality of of the stocks, because I trade a wide range. Also, as I mentioned, I'm looking for high volatility, high implied volatility, because well, that translates into good premiums. Talking about premiums, it's a rule of thumb, not a fixed threshold, but I usually look for premiums that are above 30% per annum before I even considering them as a viable candidate for the strategy. Also, as I mentioned, I don't want to get assigned, so either the option expires out of the money, or I close it or cover it before expiration. As I mentioned in the other video, this is a trading strategy, so you have to use a stop loss. There's no other way around it. I emphasize this point because on, on most of the videos you can find online about option selling strategies, they will tell you not to worry about it. You can always do the wheel, and if you get assigned, you just have to sell a covered call, and you can do the wheel over and over and over again, and you will be fine. But I don't find that to be the case. It's good to have a stop loss, and as a rule of thumb, I like to use a factor of 3 of the premium I receive, and once the spot is under my strike by that amount, that's when the alarm goes off, and I usually close the position or see what I will do to manage the position. But that's usually my rule for stop losses. As I mentioned, this is a short-term strategy, so I usually trade up to 3 weeks. I might go up to 1 month, but I usually stay in the 1 to 3 weeks range. Also, I try to avoid stocks with low prices or very small deltas, because you have to remember that for every trade you make, you will have to pay a commission. So if you are getting, let's say, a 5 cents a 5 cent premium and you're paying $1 of commission, or at least that's usually the average for me in interactive brokers, well, that takes out 1 cent. So pretty much 20% of your premium is gone just by opening the position. And if eventually you close the position, let's say you pay another cent, well, now you only keep 60% minus whatever you have to pay to close the position. So in general, I try to avoid stocks with low prices or very small deltas. I get it that given the factor of 100 that each option entails, well, sometimes it's hard to go to higher prices, but well, as long as you can avoid it, I recommend it. And also, I would like to emphasize the subjective nature of my strategy. Again, on most of the videos you can find online, they will always talk about, a mechanical approach where you can do the same thing over and over and over again and just keep collecting premiums. But I think it's a good combination to have a set of reasonable assumptions about what your options should be, volatility wise, term wise, premium wise, etc. And if you can add another layer, that in my case is to look for stocks that are in steady upward trends or lateral trends, well, I think that gives you a little extra that can help you out to improve your results. And well, this is pretty self-explanatory, but I usually look for, as I mentioned, stocks that are on an uptrend, and every time there's a pullback, for example, I like to buy. Sometimes it doesn't work, and if you get stopped out, well, that's okay. You just move on to the next trade. Also, lateral trends are pretty good if you can identify, a decent level where the stock is bouncing from. It's a good point. And I wanted to include this example because I think it's good to keep an eye for, you might be in a good trend that is going at a steady pace, but if it starts to go up parabolically, it's time for caution. I usually try to avoid stocks once they go into that phase, because inevitably, you don't know for how long it will keep going up, but the other side of the coin is that it will drop hard. And if you're selling puts here, well, you're gonna get stopped out every time, or even if it's a small loss, well, you're just gonna be accumulating losses instead of accumulating profits. Okay, so that's the general idea about the strategy. Now let's go into the specifics. As the title references, for the time that I chose, I sold 304 put options. This time frame is from June 10, 2020 to September 10, 2022. I have been trading this strategy for many years, but I chose this time frame in particular because I think it might be good to most of the viewers that nowadays watch this kind of videos on YouTube, that are mainly new traders that started since the pandemic began. So by using this period of time, I think it will be a good reference for you, and maybe you can make some comparisons to what you've been doing. So it's 304 trades. On average, all the averages I'm going to talk about in this presentation are simple averages. On average, I've been allocating about 11% of my capital to every trade. And well, I think the allocation per trade is important to mention, because of many of the videos I watched that talk about option selling strategies, I don't think anyone talks about this, and it's just like any other trading strategy. You have to manage size, prudently if you don't want to get wiped out. So in this case, I usually aim for a 10% position per trade. So it's a little off, but it's not the end of the world. Now, another important point is how much of your portfolio is actually invested on this strategy. Because once again, when you watch these videos, they usually extrapolate and talk about, the position, and you just do this n number of times, and over time, you will be a millionaire. Well, that's not how it works, because as I mentioned, or at least for my strategy, not every time I can find a setup or a stock that meets my criteria. So as you can see here, more than half of the time I've been out. Well, sorry, for during this period of time, on average, I have only been invested about 50% of my capital. So of course, this is going to affect the returns in the end, because either in a good way or a bad day, boy. We will look into that in a few moments. But the idea here is, don't assume that you will be invested all the time, because that's just not reality, or at least that's not how things work. If you are using, reasonable criteria, and you have a process that eliminates, silly trades or mechanical trades that just repeat over and over again. So keep that in mind. Regarding the days to expiration, I usually, on average, trade options with 17 days to expiration, and taking into account the ones that I close early, this goes to 11 days that I actually hold on average the options. And well, another number that I keep track of is the amount of options that I close before expiration. It's about 1/4, either because I was stopped out, or I took profits, or anything along those lines. The average delta of my trades was minus 0.22. The average strike was on average 9% out of the money. The implied volatility of the option was close to 80%. And maybe more important, the relative levels of volatility. On average, I was trading stocks with an IV rank of 24% and an IV percentile of 34%. And finally, whenever I opened a position, on average, I was receiving a premium of 1.7%. All these numbers are just, general information to put into context what kind of options I'm trading. So once again, you can compare that, or get an idea of what are the actual things that I'm doing. Now let's go into analysis of the winners and the losers. So as you can see, I have, well, for this time period, I had an 85% winning rate. That's not impressive, so to speak, because we have been trading deltas close to 20%, so that number sounds reasonable. And once again, I mention it because on most of the videos you will see, this strategy has an 85% winning rate. Well, that's not really that hard to do, mate. Just sell, just sell options with deltas of 20 or below, and trust me, you can get to that level of, or even better. Now here comes the tricky part. On average, whenever a trade was successful, it had a return of 1.32%. But on the losing side, on average, the losing trade was 5.13%. So, as I mentioned in the other video, you have a very high winning rate, but you have to take into account that the losers will weigh more. So that's something else to keep into mind. Now, once I checked the numbers between the winners and the losers, I found some things that, well, make sense once you look at them. Most of the winners have a smaller delta. Well, that sounds reasonable. And since they have a smaller delta on average, the strike was a bit further out of the money. So that also makes sense. Again, the IV rank was a bit higher. And something that surprised me a little bit, well, it was not that much of a surprise, but I also mentioned the IV percentile. I have to aim for IV percentiles, higher IV percentiles. So the fact that most of my losers are on the 30%, well, that tells me that I have to be more picky, or at least I have to remember to be more selective when I'm choosing options, to check out for the IV percentile, because it might not make a big difference, but if you can slice a 1 or 2% difference by adjusting this number, that will eventually add up. And something else that, of course, at the moment I didn't know, because whenever you place a trade, it's like flipping a coin. You never know which one is going to be a winner and which one is going to be a loser. But in general, the winners have an allocation greater than the losers, and that makes sense in the sense that I'm aware that, for example, when I'm picking, let's say, meme stocks or stocks that are more on the crappy side, so to speak, I usually reduce exposure a little more. For example, if I'm aiming for a 10% allocation per trade, when I choose one of those stocks, I usually might go to 8%, for example. And that's not a fixed rule, that's more something that, again, some things are subjective. So I'm aware that I do that, so it makes sense that the allocations are a bit smaller. And well, I'm thankful for that, because in the end that helped a little bit the results too. So what am I trading? I just this is an extract of all the trades that I made. I think this represents about 75% of the trades, so most of them. And as you can see, the underlyings are, they are from many shapes and forms. For example, my favorite one is US Steel. This has been for many years. I love to trade these stocks for this strategy. But I know, well, let's start with the names that are not so crappy, so to speak. We have Micron, we have some ETFs, I mean, the XLF, the EEM, and, well, Apache, in the energy sector. And of course, I have also traded, names that like like moth to fire, just because of the high IV. I traded Workhorse a lot, and as you can see, actually, this was my worst underlying overall. Some of my worst trades on this strategy were on Workhorse. For example, Fubo, Li Auto, Neo, that I used as an example for the other video, Kodak. What else? Oh, well, So yeah, and for example, here's a name that might stand out for some of you, the BXX. I also traded the BXX on this strategy. You might think it's not the smartest thing to do, since it it has a time decay just by definition. But well, I traded it anyway, and I was trying to to extract some value from it. But well, it wasn't one of the best trades either. But well, here's just a sample, so you can see that I traded from a variety of names. Well, what were the extremes? Well, if we go into the top winners, these were my best trades. Once again, you can see the names. These were obviously very high IV stocks. And on the other side, on the worst losers, well, the names repeat. Some of my worst trades were also on Workhorse and Fubo. RSX is a Russian ETF. This was a very particular trade. I only traded it once. But it's a good reminder that you have to be careful, and especially with position sizing, because one single trade, in this case, because, obviously for all these losing trades, I had a stop loss, but they gapped down. So the stop loss goes out the window, and that's why you can have all these big losers, right? So especially this RSX example is a good reminder that you have to use good position sizing, because imagine, as I said, I usually go for 20%. I think this trade was about 6%, so it wasn't that bad. Looking from the whole portfolio standpoint. But, if you have, I'm going to exaggerate, but if you have 50% of your portfolio in a trade similar to this one, well, just one trade can drop your portfolio by 20% in one day. So that's why you have to be careful. And just to put it into context, as I mentioned earlier, my average loss was 5.13%. If I take out these three trades, of course, I'm picking the worst trades, but just to give you an idea, the average loss drops to just 3.5%. So remember, the tail risk is very important to consider. You never know when it's going to hit, but it's gonna come eventually. So, and it will have a great impact. And also you can see the difference, right? My biggest winners, none were even above 10%. But the losers, one was, well, all were obviously above 10%, but one was 4 times as much. So that's why you have to be careful. Okay, so finally, what does all these numbers translate to? Well, I thought the easier way to compare it will be to see what would have happened if I had just invested 100% of that portfolio into the SPY and compare it to what happened to the actual strategy. Once again, I wasn't invested 100% all the time, so that's a factor to take into consideration. But I'm not adjusting. I am not making any adjustments because after all, being out or in the market is also part of the strategy, in my opinion. So here are the results. And as you can see, well, they are not that great. If I just bought the SPY, I will be up compared to the strategy. And of course, I would have saved a lot of time, some stress too. But in the end, the reason I have this strategy is because I want to diversify. So this is not the only strategy I trade, of course, but it's another way to be exposed, to be long the market, but with certain characteristics that help me to diversify my overall investment universe. As you can see, one of the benefits that might be counterintuitive, especially if you manage, with the strict stop losses, it's not that volatile. The strategy, if you compare it to what the SPY did during that period of time, I mean, I didn't calculate the number, but as you can see, even if there are some drawdowns. For example, this is the RSX drawdown. And here is the February 2021 drawdown, when many of the meme stocks started to fall hard, like Warhorse and Fubo and Li Auto. But other than that, as long as you keep a decent stop loss parameter, since the winning rate is very high, you usually will see something that trends upwards in a steady fashion. So again, the returns are not maybe I'm not comparing apples with apples, but in the end, one of the pros that I will underscore is the reduced volatility. Even though by trading options that might sound counterintuitive, but well, as you can see, with good risk management, you actually can have a portfolio that is highly correlated to what the market is doing. You're long the market, but with much less volatility. And in that sense, I wanted to mention and emphasize the part of the percentage invested because, as I said, that's also part of the strategy. The decisions you make of how much exposure you have to the market are also relevant when you are trading or you have an investment strategy. In this case, I divided in 3 sections. The first section, let's call it the regret phase, because this is clearly a phase, hindsight is always 20/20, but this is a phase where I should have been more aggressive. I was only on average invested about 60% of my portfolio, and this was clearly a period of time. I mean, it was still 2020, so we were still a little bit shocked by the drawdown on March, but clearly this was the best stage to be investing in this strategy, even though the market was volatile, because you can see here, even there were some drawdowns on the SPY, the strategy kept working really nice. So again, hindsight is 20/20, but here I should have been invested more. Then I made a cutoff on February 2021 because, as I mentioned, that's when most of the meme stocks started to get hit hard. Actually, if you look at a chart of ARK Invest, for example, I think the top was around those dates. So here's when I had some of my first serious drawdowns on the strategy. And during this period, from February to October 2021, that's when I was invested the most. But the returns were not as good. So you can see even the strategy was going up. The slope was not as pronounced as earlier. So maybe I should have been less invested during this period, but well, who knows. And also, well, a good observation to make is even when I was the most aggressively invested, on average, I wasn't invested 100%, or I didn't even go into leverage. I use a margin account for these strategies. And, in the past, I have been leveraged in these strategies, but, this time I didn't even get close. And the third cutoff is October 2021. Well, November 2021, sorry, to September of this year. And you can watch a video I made in November of last year when I talked about how many of the market conditions were deteriorating, and I didn't like it a lot. So once again, I incorporated that into the general strategy. And as you can see, on that period of time, this strategy has been pretty much on the sidelines. I have only been invested on average an 8% of the portfolio. And well, you can tell by the very small, it has been pretty much flat, but only very small moves. And actually, once again, this is the RSX drawdown. So just one trade makes an impact on the charts. And well, that's that's what I wanted to share with you guys. So what are the main takeaways from this presentation? Well, I guess as I mentioned in the previous video, but I think this time we put some numbers, real numbers, and some actual market activity behind it. And the main idea is that selling puts or selling options in general is not a special, quote-unquote, special strategy that will make money all the time, okay? Like with any trading strategy, you need, of course, to manage your position size carefully, because that can have a huge impact on whether you survive or not, whether your account survives or not. Also, you have to use stop losses. I mean, don't be arrogant. Don't think you have found the strategy that will beat the market every time. You never know what's going to happen, so you have to be careful, and protecting the downside is, with good position sizing and prudent stop loss use, I mean, you mitigate maybe 80% of the downfalls that you might find in your trading career. So please don't think that selling options is somewhat special and can, and voids the fact that you have to use these mechanics. Also, as you can see from all the numbers that I showed you here, it's a good practice to track your results closely. I track many more variables that I didn't share in this video because I try to focus only on the mainstream numbers that might be more easily digested by the viewers. But you can have a good amount of variables that you're tracking, and for example, maybe half of the things I track don't really have an impact on my trading, to be honest with you. But as time passes and the market changes, sometimes it's good to have some different references so you can analyze and find out if there's something else that you must be doing, or if you have to skew your strategy one way or the other. And of course, based on that analysis, you can adjust and make changes as you see fit. And please don't be a proud, quote-unquote, proud bag holder. I guess it's, human nature to try to put a positive spin or a funny spin whenever you watch some of the videos that talk about the strategy is not working that well, but I'm back holding and it will come back eventually and blah, blah, blah. Come on. Trading is not about being loyal to a stock or a strategy. If it's working, use it. If it's not, stop, adjust, and move on to the next trade, okay? Don't try to rescue trades that are, deep in the hole. Just let go. I guess that's the point. Just learn to let go and move on to the next trade. So that's it for this video. It's a little bit long. I thought I could go under 20 minutes, but well, anyway. I hope you found it interesting. If you have any comments or suggestions, if you found anything interesting, or you want to share some of the own things you track when you trade this kind of strategies, please share in the comment section below. And as always, remember to like, subscribe, turn on notifications, and all that good stuff that YouTube wants you to do. Well, thanks for your time. Have a good one.